Welcome to this week's episode of Accredited Investor Markets Radio. Each week, we speak with you about investing in alternative assets. Unbiased and beholden to no one, Accredited Investor Markets Radio does not accept advertising from any investment firm or financial advisor. Accredited Investor Markets Radio is the spoken word sister of AccreditedInvestorMarkets.com, the internet's most comprehensive and unbiased educational resource about crowdfunding, angel investing, venture capital, private equity, private shares, and other investment classes beyond publicly traded stocks and bonds.
Well, hello and welcome to Accredited Investor Markets Radio. I am your host, Christopher K. Hill. Later, we'll have an interview. Our the managing editor of Accredited Investor Markets, Alicia Purdy, will interview Joey Jelinek, co-founder and CEO of GroundBreaker.com. Excellent. That's a dynamic title for a company. But first, a few relevant recent writings. In the November 4th edition of the Wall Street Journal, there's a headline of an article written by Timothy Hay. The headline is, MD Insider CEO says syndicate crowdfunding is, quote, wave of the future, end quote. Syndicate crowdfunding. Well, I'm going to caution you because we're going to talk about crowdfunding today, but it's all about accredited investor investments and not about true crowdfunding. It's a distinction I think should be insisted upon. I insist upon it, although the Wall Street Journal evidently does not. Crowdfunding means funding by the crowd. It's funding by everybody. And those rules that enable that kind of funding have not quite been resolved by the rule makers in the federal government. Meanwhile, we have had a loosened environment for investment by people of means, accredited investors, those who make $200,000 in the last year and expect to do it again this year and shift those numbers to $300,000 if married filing jointly, or who have $1 million in assets other than their principal residence. But anyway, I don't want to quibble too much. I just want to make sure that we know what the MD Insider CEO says when he says syndicate crowdfunding is the wave of the future. The hero of the piece is David Norris. David Norris is the co-founder and chief executive of medical search technology company MD Insider. He is also a veteran of startups. Mr. Norris knows from VCs, PEs, and angels, that is, venture capital firms, private equity firms, and angel investors. He knows all about them and knows the drill. He's a veteran of 6 startups, and they're successful startups. And how do I know that? Well, I know that because there's a photo of Mr. Norris. He has somewhat long and expensively styled, but seemingly casually tousled hair, and no tie. Those are the surest signs of success in this area. Okay, that was needlessly vicious, that comment, but I hope I didn't offend Mr. Norris or his family. I'm sure he's a wonderful guy. He's certainly a very successful and wise entrepreneur. This time around, Mr. Norris got $2 million from angel investors. By the way, in the past, he's had angel investors such as Mark Cuban invest in his companies. But he gets $2 million in pocket. So you have $2 million, a good idea, and you are David Norris, somebody with a track record, somebody with credit, somebody in whom others believe. The Latin root for credit is credo, which is I believe. That's a powerful combination, money, an idea, and credibility. So anyway, he took his company to an equity crowdfunding platform, AngelList, and that's AngelList, all one word, 2 L's, AngelList. And at AngelList, MD Insider raised $1.5 million in, quote, pre-Series A funding, end quote, from hundreds of investors within a matter of minutes. Minutes! Again, the triple play of great idea, great track record, and $2 million in pocket as seed money can be very powerful anywhere. But now the technology of AngelList puts that triple play together with something called syndicated equity investment. So syndicated equity investment is basically, on AngelList, is accredited investors invest in syndicates. The syndicates quickly can decide whether to invest in MD Insider or some other vehicle. By the way, MD Insider, just so you can put some flesh on the bones of the company itself, is described by Mr. Norris as, we use big data to evaluate the performance of physicians. We aggregate volumes of data and find the highest performing and most cost-effective doctors. Then we sell a search tool to employers that helps them lower their health care costs. Well, all right. The intention is to more efficiently deliver the most efficient medical care, or at least medical care packages, to employers who are obviously looking to save money and get the most for it. So moving on to more about crowdfunding, but not really crowdfunding, we're really talking about accredited investing. The October 27th edition of the Washington Post has an article written by Stephen Overly entitled Crowdfunding Platform for Budding Restaurateurs Debuts in the District, and the references to the District of Columbia, our nation's capital. The restaurant in question is a bakery named Bluebird Bakery that needs money. So Bluebird Bakery turned to another platform. The platform is called Equity Eats, all one word. It's a website tailored for food and beverage establishments. Now think about that. The specialization implies that the people running the website, which is really an equity investment platform, know their knitting. They know what food and beverage establishment ideas might be better than other food and beverage establishment ideas. Now, Bluebird Bakery does not have the cachet of David Norris's track record, nor do they have $2 million in seed money from an angel, but they do have Equity Eats. I took a trip to the Equity Eats website and found that Bluebird, oh, by the way, the website's only been up 1 week. The article came out just before launch of Equity Eats. And a week into the existence of Equity Eats, Bluebird has 5% of its equity offer subscribed. So it needs $485,000 and has 5% of that. What's interesting also is that, or to me, is that what are they offering? Well, they're offering 40% of the equity in the bakery. But more than that, they're offering that the investors who cough up the $485 in this round will receive 75% of the restaurant's profits until they recoup the initial investment, and then they get 40% of all subsequent profits. Now we know that restaurants come and go. They don't always succeed, far from it. However, when they do succeed, they tend to succeed pretty fabulously, at least for a period of time that might be attractive enough to these sorts of investors. Equity Eats is bringing the investor together with the opportunity. The last article we're going to consider today is from a very reputable source, accreditedinvestormarkets.com. Posted on October 27, 2014 on the website that sponsors this very podcast is an article by Melissa Rudy entitled, Does the Early Bird Get the Return? And it ponders some recent activity among venture capital firms nationally. So here's the data. In 2013, U.S. venture capital firms raised 10% less than 2012. All right, so VCs were raising a little less money. But over the same period, the amount of VC money raised for early stage investing rose by 51% to a total of $9.37 billion. So less overall activity, but more of the existing activity than before was for early stage investing. Now, venture capital firms aren't usually there at the early stage. Early stage investing is dominated by friends, family, and angels like Mr. Cuban in the example of Mr. Norris's earlier enterprises, or other angels who like to take a flyer, maybe invest a serious amount of money that they have to play with, really, and participate as gray eminences helping the young company along. I mean, that's kind of a standard picture of angels. It's their own money, and they're doing it for fun as well as a desire to help out and a desire to make money if it succeeds, knowing that early stage investing is highly risky. Venture capital firms have a different profile altogether, as many of you know. Venture capital firms are answerable to their own investors. They have to get returns. They're less likely to take a flyer on something. They come in later after the success of the seed money and the angel investors has the entrepreneur up and running. Then the venture capital firm comes in, swamps the place with cash, and dilutes the return for everybody else. Again, another caricature, but here we see venture capital firms increasing their activity in startups even when they're decreasing their activity overall. Well, why is that? Ms. Rudy posits several factors. I encourage you to read the article. But some of them are focused around the increasing smart technology, the ease and lower cost of communication, research, product development, marketing, and other aspects of starting a business. shorter product cycles, especially for technologically oriented businesses. That is, products don't last as long. They need to be replaced. Are we up to iPhone 14 at this point? I know that's a very weak joke, but you get the point. And related to that is easier globalization. We don't hear so much about globalization. It was controversial a few years ago, but it continues. Facebook is with us, and it's everywhere throughout the world, for example. So there are more potential customers and clients throughout the world. Middle classes have expanded notably in China and almost as notably in India, Turkey, Brazil, and actually throughout even sub-Saharan Africa. There are more people in the middle class than there were before. So there's an atmosphere for entrepreneurs at least to get off the ground. She also cites customer or consumer input, which of course is easy with interactive technology. Consumer input used to be limited to price, to purchases, but now you can get more from consumers by soliciting their views. I'd like to suggest that there's another factor perhaps at work here. Venture capital firms are seeking value. Of course, that's why they exist. But maybe value is a little harder to get in this era of low interest rates, an era fostered by policy decisions, including policy decisions by the Federal Reserve Bank of New York and the Federal Reserve System in general, which have depressed interest rates to a very low amount, which is fine if you're a borrower, and if you are a borrower who can get a loan from a bank at low interest rates. Great. But not everybody can get a loan from a bank at a low interest rate. And that's fine for them. But what about venture capitalists seeking yield? Well, there's going to be fewer instruments out there that have high yield when interest rates are artificially low. So they need to find yield, and so they're searching for yield. And I think perhaps along with the factors Ms. Rudy points, it is the venture capital firm's desperate search for yield which accounts for the fact that a greater percentage of their raising is focused on startup companies at this point. Well, that's enough pronouncements from the mountain for now. It's enough from me. Let's get to the interview.
This is Alicia Purdy, Managing Editor of AccreditedInvestorMarkets.com and your host for this week's broadcast. Joey Jelinek is the founder of GroundBreaker. He has spent his career fundraising for institutional real estate owners on Wall Street. Joey experienced the painful and tedious process of private fundraising when he founded Byron Partners, a small balance real estate firm. Joey graduated from Cornell and has his master's in real estate from Columbia University. Welcome, Joey. We're glad to have you with us.
Thank you. Thank you so much for having me.
To begin, would you please introduce GroundBreaker to our audience? Tell us a little bit about how it began, what it does, and kind of fill us in on some details.
Sure, gladly. So GroundBreaker.co has two lines of business, essentially. One is a real estate crowdfunding marketplace, and the other is a portal building business. So real estate crowdfunding, if in case your listeners are not familiar with it by now, is essentially just where you pair up with investors and sponsors. So people that have real estate deals that are raising money for, and people that have money to invest in real estate projects. So obviously, real estate's a big space that can mean a lot of things. What we do at GroundBreakers, we focus on middle market institutional quality deals. So deals that are between $1 to $10 million in equity or $5 to $50 million in total capitalization. We've done equity and debt offering types and preferred equity and mezz, but we mostly focus on equity. So to give you an example of a typical deal and kind of the structure of the capital stack of it, and then, a developer, let's say, has a total project of $20 million and they're going to raise, let's say $7 million of equity. They'll come to us, we'll raise $1 million from our investors, and then the sponsor will go get $6-7 more million from an institutional equity partner, and then get on the remaining 13. So that's sort of a typical deal for us on the real estate crowdfunding marketplace side. The portal building business is a new business line for us. It's software that automates the entire fundraising and investor servicing activities. We're solely focused on the real estate markets from both the software, the portal building business side, as well as the real estate, crowdfunding side. And the two recently started to integrate the two of them. So what that means is our portal clients, so those that use our software, can, subject to our approval, post deals onto the marketplace. So essentially, we kind of have two lines of business, the real estate crowdfunding marketplace, the portal building business, and the two sort of interact with each other.
Okay, so on your site, there are two major options when you first get to your page. One says, I'm an investor, and the other says, I'm an issuer. Can you walk us through, if someone came in and said, okay, I'm an investor, click. What's the process next? And the same thing for I'm an issuer, click. What would they go through on either end through GroundBreaker?
So starting with the investor, you would first be asked to sign up and create an account with just very basic information about you, including if you're accredited or not. And then you can browse the deal offerings. We have 506B and 506C offering types. Most of them are Cs. So the Bs, you would have to be invited to see them typically. But the first step is to create an account and then obviously browse the offerings that are shown to you. And if you like one that you see, there's almost like a teaser, what the industry they call a teaser, just very basic information on each deal. And if you select one, then you get full-blown content on that deal. And you can browse through it. You can engage directly with the sponsors. You can communicate with them. You have all the due diligence materials available to you. You have everything that you need to sort of make an investment decision, including access to the sponsors, the principals, us, and so on. If you liked what you saw and you wanted to make an investment directly through the site, we facilitate that as well. There's an invest button. You click on it. At that point in time, if it's a 506C offering type, we'd ask you for a little bit more information, so we conduct more thorough background check on you, make sure you are accredited, and do other types of sort of basic checking. And assuming that you pass that inspection, then you'd be allowed to invest directly through the site. And the process is very straightforward. Step number one is input the amount. The min and max that you can invest per project is set by the sponsor, not us. So the minimums can vary, as low as $1,000 to $50,000, as low as we've seen so far. Same with the max that's set by the sponsor. So step one would be enter the amount. Step two would be e-sign all the legal documents, which usually is a subscription agreement, operating agreement, typical type of, partnership agreements that you'd have for a private placement. Lastly, we have wiring instructions, so you can, wire funds or ACH the funds, or there's also a widget there that allows you to, input your bank information, and we run an automatic transfer. If the deal is successfully funds and closes, then you can log into the same place and download all your statements, your K1 reports, quarterly statements, updates, etc., all from the same place. From the issuer side, if you click on the issuer button, essentially you'll just be brought to a page where you can submit information about yourself if you want to post a project, or if you want to, license software from us. So there's, in that way, from the sponsor side, there's kind of two avenues you can take, right? One is I just want to post a project. Another one is I want software, and some people want both. So if you just want software, it's pretty straightforward. It's a separate conversation. This is how the software works. We give you a demo of the software and kind of walk you through the entire process, obviously answer any kind of questions you have in regards to software, but also in general into crowdfunding and fundraising online and that sort of thing. We help, our clients kind of guide them through the process of what that means, because since it is a new thing and people in the real estate industry have been raising money the same way forever, most are not familiar, with the process and how it works. In addition to our software, we spend a lot of time educating sophisticated institutional operators about how this new process works. If you want to post a deal, we typically obviously go through that same, educational process, but, there's less involved in the sense that, there's not really demoing as much software. It's much more straightforward conversation. It's, hey, I have this deal, I need money for it, let me send you the deal materials, and are you interested or not? So that's sort of the two general avenues that we take with sponsors.
Okay. You brought up technology. Let's talk about technology for a minute, specifically for the sponsors, which is who it's really particularly for. They can rent software services. Can you explain that? How does that work?
Well, let me back up by saying, give a little kind of historical context.
Sure.
Since the Great Depression, private placements have, people were not able to generally solicit investors, or pitch them on a deal without having a prior and existing relationship with them. So what that's meant is that people, since the last 90 years, and actually anyone that's alive today, has raised money a certain way, and that certain way has been you go out and you network and you meet people, physically meet people, have a relationship with them, and then, you can obviously pitch them your deals. And so the entire process is it's always been offline. It's very archaic and old school. It's, lots of personal meetings for coffee and so on, and then, putting pitch books together and sending them over email and having phone conversations with them. And so now, with the passing of the Jobs Act, a lot of that has changed for those that want to pursue that avenue. And so it's made it really for the first time, I guess you could say, a need to bring the fundraising process online, because if you want to open up a deal to, lots of more, investors, doing it the traditional offline process is really inefficient and it's not going to work well. So it kind of creates this need for bringing your fundraising online. Therefore, we have obviously provided technology, and sure other people have, that will sort of facilitate that process. So in so doing, we've come across a lot of institutional companies that liked the technology that we built. I mean, initially we built this for ourselves, right, so that we could have the marketplace and match, high-quality institutional sponsors with, high net worth investors and accredited investors and even institutional investors through a marketplace. But a lot of these institutional sponsors, the owners and operators of the properties, when we were trying to court the ones that we liked that had really good track records, and we were trying to court them to put their deals on our site, many of them, since this is such a new and foreign idea to them, they weren't that comfortable with it yet. They didn't want to open up these deals to new investors they didn't know, but they really liked our technology. And they said, you know what, bringing this online and makes it much more efficient. It automates a lot of the activities. So, while I'm maybe not interested in crowdfunding, I am interested in your guys' technology. So would you be willing to license it to us? And at first I said, well, that's not what we do, so thanks but no thanks. And we had enough people ask us that we finally took it seriously enough to put together a demo of just for licensing. And it was met with, overwhelmingly positive response, and so that's why we added this new business line. And essentially what it is, it's what they call SaaS, software as a service, that just allows, real estate companies to have fundraising and investor servicing software.
We operate under the understanding that every investor, the burden is on them to do their due diligence, of course, and the buck really does stop with them. However, how does that work? Does GroundBreaker have any role in that? Do you check into anything like that? Or is it sponsor or issuer comes in, they put it in there, investor comes in, takes a look, and then does their own due diligence? Or is there a measure of it already presented to them that they can run with? Or do they start from scratch?
Yeah, no, it's a very good question. No, we do due diligence. What that's done for us is allowed us to focus on higher, quality institutional operators. Granted, that of course means we're putting less deals on there, but we feel that that's better because we'd rather put less higher quality deals than just more stuff. And we've definitely noticed a trend in the industry in general for crowdfunding where a lot of people tend to be competing on activity and how much deal and volume they can do, and we definitely don't think that that's a good idea and didn't want to be in that game, so we'd rather have less but higher quality deals, which has been our approach. Another thing to keep in mind is that we don't monetize on the marketplace. So we actually co-invest in the deals ourselves, and we don't monetize in any way from these deals. So we really don't have an incentive at all to put just anything on there. So we really curate and really look through the deal, the operator, their track record, and really only put stuff that we think is that we believe in, on our site.
Okay, here's a question that I think every modern person would probably want to know. Because you're so technology-based, is this something that has to be done from a computer? Or can they pop on their iPhone, their iPad, their Droid phone? Does it work like that, or is that completely irrelevant?
Our site is optimized for mobile, so you can definitely peruse and invest from a laptop just like an iPhone or an iPad or anything like that. You wouldn't be able to do it, offline. You'd need some kind of mobile device that would connect.
Sure. But you can be on the go. You can be on a commuter train or hopefully not driving, but in a car, and you can pop on and check out what's going on or look at some details or from either side, from being the sponsor or from being the investor. Is that accurate?
Yeah.
Okay, if you can compare and contrast, we have learned at Accredited Investor Markets that traditional capital raising methods have their limitations and possibly their benefits too, but that things that are just taking off online, like GroundBreaker, are really sort of causing traditional investment methods to pale in comparison. Can you kind of compare, contrast the two as far as what makes, online so great versus traditional capital raising, which tends to sound like it's a little bulkier, for lack of a better word?
Well, the actual process is very similar. I mean, like I mentioned before, I mean, it's just efficient because you're bringing it online, right? So it's more transparent, it's more efficient, as opposed to relying on a lot of offline kind of activities or processes. But other than that, I mean, the basic idea or the basic function is pretty much the same. I mean, I'll give you an idea of how we did it, like in Morgan Stanley and CBRE versus how we do it online, and so like let's say at CBRE, a developer would come to me and would pitch me a deal, and I'd review it, and if I liked what I saw, I'd put together marketing materials, and I'd go put together, at that time I was only only raising money from institutional investors, so I'd put together a list of, 50 institutional investors and email them each, a package of content. They'd review it, and if they liked what they saw, they'd ask me a bunch of questions, usually through email or the phone. If they became comfortable with the deal and they liked it, then they'd ask me for more due diligence materials, which I'd go and then get back from the developer, and then email back and forth, and blah, blah, blah. There's a lot of email and phone back and forth. And ultimately, if they liked it, they'd wire a check to an escrow account somewhere. In terms of the process is still, not the activities, but the actual high-level process is still the same, right? On GroundBreaker, a developer pitches me a deal, review it. If we like it, we post it to investors so that they can see it and they can conduct their own due diligence. But the actual activities, since it's online and you're adding technology to the equation, is much more efficient. It's much better for everybody involved, right? People don't have to check 50 emails to get random different pieces of information and ask for more information and get it back. They can just go to a website and see everything, and ask everything in one place. And so it's really streamlined a lot of those sub-activities, and it's made it much more efficient. But the process is ultimately still the same.
So is technology influencing what types of investments are made? Like specifically, maybe it's access to deal flow or even better opportunities because of technology? Have you found that at all, that technology in and of itself is influencing the type of investments that are made versus investments that people would have made in the past?
I mean, what it's doing is, since this process is much more efficient, you now have these operators that are open to and increasingly becoming open to opening up their deals to more investors, right? Because, this archaic process that I described is so cumbersome and time-consuming. If you did it offline, nobody in their right mind would want to, at least no seasoned, experienced, reputable, good developer would want to take on more investors, just because it'd be such a nightmare and a headache to do. So they don't. But now, since you can do it online and it's efficient using, our software, they'd say, what, sure, I'm now at a point where I can feel comfortable opening up this exact same deal to more investors. So what that's done on the other side, is that's opened up that same deal to other investors that wouldn't have otherwise had an opportunity to invest in that deal. So for the average person, it's given them much more deal flow. Apart from the obvious fact that you can go to a website and just get a centralized place where you can see multiple deals, it's obvious, but it's a big point, right? Because historically, since nobody was transacting fundraising online, it was very much back to that old school kind of personalized face-to-face process. That meant, if you had extra money you wanted to put into real estate, you either had to have obviously an established friend and family connection. Even then, you were still limited to that friend and family network you had, so that if you wanted to go beyond and access more deal flow, you would have to go to real estate networking events. You'd have to go to other kinds of networking events, join more country clubs, it sounds silly, but it really is what you'd have to do. And if you're not a full-time real estate investor, that's not your day job, that's kind of who wants to go and do all that work, right? So having a centralized place where you can access all these deals is nice. Obviously, it's something you can do on GroundBreaker. And having the efficiency provided to these operators that they can take on more investors allows them to then open up those deals to new people. I think that's sort of the biggest boon there. Aside from that, I think people are making different investment decisions, meaning like if you never liked retail, you're not about to start investing in retail because it's on the internet. You're going to invest in things you like and that you're comfortable with. So people that like investing in hotels will be investing in hotels. Just the difference now is they can invest probably in more of them because they can go to one place and see more deals. Another thing too is that because of this efficiency brought on by technology, the cost to service the investor has dropped, such that these operators can take on smaller denominations from each individual investor, right? So if I'm an operator and I need $1 million, and technology, let's just say, made it no different that if I got the $1 million from one guy versus 10 $100,000 checks, then I'm kind of in a way indifferent, almost being equal. I'm kind of in a way indifferent. The positive sides to the individual, accredited investor is that if I only had $1 million to invest in real estate this year, my allocation, historically that probably meant one deal, or let's say 2 deals or whatever it was, right? Now I can do 10x that because these operators are willing to take on smaller amounts because of technology, right? I can now take that same $1 million and put it into 10 different deals. And I have, and technology, of course, since it is giving you a centralized repository, in a lot of these marketplaces, I can also invest in other markets, right? So historically, like let's say I lived in, San Francisco, and I'm limited to people that I know. Most likely my investments are going to be limited to San Franciscans, right, or San Franciscan assets, right, because that's who's in my backyard. So I probably wouldn't know anybody in LA. Even if I loved the LA market, I probably just didn't know any operators there. Now with the internet, social media, LinkedIn, all these other mechanisms, I can meet LA developers. I can meet New York developers. And, for the big cities, maybe that doesn't seem as important, but for lives, in smaller cities somewhere, I went to school, like you mentioned, at Cornell. So the guy who lives in Ithaca, accredited investor who lives in Ithaca, being able to now have over the internet access to deals in other markets is pretty big because Ithaca's far from these cities. So that really opens up a whole new level of sort of geographic portfolio. It really allows people to have geographic and other kinds of portfolio diversification with the same amount of dollars and time that they didn't previously have, which is, a really big benefit to the individual investor.
Okay. Well, I'm going to just wrap things up and ask you to give us some forward-looking thoughts about where the market will go as far as out as you want to go, 5 years, 10 years. Where do you think the industry is headed? And if you were to make a prediction about the market, what do you think will happen?
What we've already started to see happen is that a lot of the bigger institutional guys are getting involved. This will certainly continue. It's a natural extension of their brands and their track records, right? So if you're somebody like, Blackstone or, right now, you fundraise from your, traditional, the larger institutional guys fundraise through the broker-dealer networks, right, and placement agents. And the broker-dealers, obviously, the ones that, and the placement agents are the ones that have the individual relationships with all the accredited high-net-worth investors. So what's happening is a lot of, these larger institutional firms are very interested in the space in terms of bypassing the broker-dealer networks and creating relationships directly with accredited investors, which is huge, right? I mean, it's very disruptive for obvious reasons, to the broker-dealer community. And I think it's a huge plus for, accredited investors because not only do they save, ultimately, these people's salaries and have to come out of somewhere. And who pays for it? The investors do. And the broker-dealers, they charge pretty big loads, 10+%. So apart from the fact that, so one, you have it's cheaper for the investor to invest directly, and secondly, it's more transparent because you don't have a middleman anymore. You're definitely starting to see a lot of these institutional guys that come to us. They're inquiring, they're learning more about the space. They're still kind of deciding how they want to roll it out, but they definitely want to roll it out. I think right now what we're seeing is they're really just trying to figure out what's the best way to do it, not if they're going to do it. It's just how are we going to do it. And so I think in the coming, let's say, year, 2 years, you're going to see a lot of these high-quality institutional owner-operator developers start to post their projects, online and bypass the traditional broker-dealer so that accredited investors can directly invest into their projects and create, direct relationships with them. So that on the real estate front. I know on other fronts that's happening as well, like on hedge funds, private equity. I can only speak for real estate because that's, the space that I'm directly tied in. But these people are going to do it much. They're going to do it on their own site, and that's really kind of speaking to the second, business line, the portal building business. That's really why we started that, was because of these guys that said, look, we have these track records, we have our brand that we want to leverage. We want to maintain control of the experience and of the process, and we're not going to go post our deals on somebody else's site or somebody else's marketplace. We're just going to do it directly. So that's why, our marketplace really is kind of like an amalgamator of the best-in-class operators we send out there. They are fundraising online. That's kind of the best maybe description you can have, for our marketplace. But you can obviously, you don't need to go to our marketplace. It just kind of gives you, it's like almost like a Google, if you will, of what we think are the best operators out there that are fundraising online. But you don't have to go to our marketplace. You can go directly to their site. And I think that that's ultimately what you're going to start to see, is you're going to start to see all these companies just post their projects on their own sites and allow certain people to, credit investors, et cetera, to invest directly in those projects. So if you have a company that you like, now I'm talking like 5 years plus, 8 years plus, from today, you will probably be in a world where, there's a certain brand that you might, have heard of, your friends will value, man, this brand, Blackstone or whatever it is, right, is really good. They're really good at real estate. They do, very spectacular performance. And you just go to their website, you sign up, and you can just browse all their offerings, and you can invest directly in their offerings, just like you can kind of buy shares of Coca-Cola today on many of the sites. So it'll literally be that easy for you to buy into alternative assets, like real estate, private equity, which has historically been something that you can really only do through, the broker-dealer networks. So it's like a direct accessibility that you're going to start to see more of, especially in the institutional side.
Okay. Well, that's great. We always love playing around a little bit with some forward-thinking predictions just to see, speculate what could be out there and where things will go. And it's always interesting to our audience to do that because there's so much happening. I mean, there's just so much buzz going on, and there's a lot more that will continue to unfold. Thank you, Joey, for taking the time to speak with Accredited Investor Markets Radio today. I want to tell our listeners that they can find more information about Joey and about GroundBreaker by going to www.groundbreaker.co. We hope you tune in next week. I'm your host, Alicia Purdy, and we will talk soon.
Thank you for joining us. If you enjoyed this episode, you can subscribe through iTunes or Stitcher, or you can download our app from Libsyn. You can also listen right on our website, www.aimkts.com. Each week, Accredited Investor Markets Radio brings you news and education about investing with a focus on alternative assets. To see a short written summary of this episode, go to www.aimkts.com. Accredited Investor Markets Radio is a production of Financial Poise Radio Productions, LLC.